Hey Trader Steven here. It's Thursday morning, October the 11th. I figured I'd go ahead and shoot this in the morning just based on the volatility. I wanted to go ahead and get out, what I think is going on and just kind of try to look at some of this market action objectively the best that we can. So I'm going to get started. Let's just kind of hop right back into a Nasdaq. So right now up here, we are 9% off the high, and I'm looking at the futures, and it looks like we're going to be down at least 10 to 11%, down another 2%. So, we have a waterfall going on, but this is nothing really new even this year. I know the trend has been nice, then it started to chop up around here, but if you look, the waterfall we had at the end of July was 12%. And then the next waterfall, just a couple months later, was 11%, and we haven't even reached that yet. So just kind of, it's important to put things in perspective. This has already happened twice this year. Each time we've had a reversal day, found a reversal at the long-term moving average this time. We had kind of, I would say, an outside day right here. I wouldn't call it a reversal because it didn't necessarily undercut the prior days, but some signs of support. We have not seen that yet. So what I would be looking for is, maybe even if today the market does reverse and comes back and closes in positive territory, that's what you want to see to maybe stick your toe in the water. Now, I say stick your toe in the water because I like to advise with caution. This, as you can see, anytime you have a waterfall, it rarely is a V-shaped recovery. And what I mean by V-shaped, like this would be considered V-shaped, but even as it broke to an all-time high, it immediately got slammed right back down. So typically it takes the market or even an individual stock time to digest this pullback. Like it'll bounce back hard, suck everybody in, and then you think that everything's good, and then it's going to slam you back down again. And we're going to look at the past corrections just to put things into perspective. But if we look at this and we talk about a couple personality changes. One, on the bigger picture, on the correction picture, you can see the last two corrections found support at the 200-day moving average. The Nasdaq did not. So we have a change in personality where the 200-day moving average isn't necessarily the line of support. So if we look at that on a shorter term picture, we can obviously see even on the 50-day moving average, you had a trend that continued to find support at the 50-day moving average, breaking out to new highs. It almost made it right here, but it came right back down, broke out, and then this time it didn't and it failed. So you have 1, 2, 3 successful tests, maybe even 4, but then you had a personality change right here. This is the moment where you should have definitely been waking up and taking some profits, or selling some stock, or at least raising your stops on some of your short-term money. Now, long-term money doesn't really matter, right? You can hold on to that. You're gonna have to sit through a lot of these if you have anything long-term. It's just the nature of the beast. But on the short term, definitely on this bar right here, you should have been waking up, probably even starting to get stopped out of some trades. And I started taking some profits. I think some of my stocks started to break the 50-day moving average right around the Nasdaq did, and I just got out. Like, that was my line in the sand. That was my stop. I like to use moving averages because they're simple, especially with strong trending growth stocks. But right up here, if you're starting to get out down here, I guarantee you're probably hurting unless that your stocks have been holding up and they just now are starting to break, which in that case is okay. So, I always say anytime we have a pullback or correction on individual stocks on your short-term positions, just know where you're getting out. Some might hold up. Most will not when you have a sell-off like this. Some will hold up when you have a pullback. So you got a pullback, 3 to 5%, and then you have a sell-off, which is closer to 10+%. So always know where you're going to get out. But, we have a personality change right here. And now we have, on the bigger picture, a personality change right here. So I just kind of want to remind you, and we're going to go back and look at some corrections. I always like to review past corrections just to understand what we've been through in the past. Let's look at the S&P 500 real quick. We were in this rising channel. boy, that broke wide open yesterday and hasn't quite broken the 200-day moving average yet. But you can see all the distribution coming in. If I go back to the Nasdaq, you can see all the distribution down here, the above average volume selling. So, you know why this is happening. People talk about interest rates. To me, it almost really doesn't matter if you're making a lot of decisions on charts, because, you know, the market climbs a wall of worry, and it's important to not overemphasize on the why, because then you tend to have a bias on what you think the market should be doing. And sometimes you can, you think the market should be going up, so you stick with your positions, and then something bad happens, or, you think the market should be going down, and then the rally takes off without you. So just make sure that you don't focus too much on the why, focus on the what, on the daily price action, because that is what is going to help you out more in the long term. So the small caps, I want to look at the small caps right here. Just clearly here, let's measure this to see how down this is. We have, also down about 10% from the high, the small caps, and that's, again, that's just a correction. That happened a couple times right here, but you can see each time it found support at this trend line, and now it didn't. So, it's important to take notice. We're going to look, the only real V-shaped kind of waterfall pullback like this I remember was in 2014, and it was more of like a 6 to 7% where it went straight down and just came back and went straight up. We can look at that too, but this is when it bottoms, it's going to pop, it's going to come back hard, probably look good in here, and then it'll roll back over. That's just, you can look at any chart, you can look at any correction, that's what they do. So you're probably better off, pushing the button somewhere down here if you're going to take a stab at something with a real quick, tight stop, because you don't want to just get involved in something too bad. And if it bounces, you can sell in a strength versus waiting till it comes all the way back up here and then, start to get sucked in, which I'm going to stick my toe in the water, and then, I'll probably stick more toe in the water up here, but with a very tight stop in case it rollovers, which it likely will. I do want to look at the bonds real quick, just the TLT, because they are selling off too. They can kind of continue to be, this is the TLT, the 20-year Treasury ETF. They continue to be ugly. They have broken this horizontal support, this double bottom, and are now kind of down here in this zone. But bonds I believe sold off before stocks did. And if you read the intermarket analysis book by, I believe it's John Murphy, he talks about bonds sometimes they sell off before stocks, and then they bottom before stocks. So sometimes what you think is conservative isn't. You look at a portfolio in 2008, a diversified portfolio, it still got crushed with everything else. So I think it's just important to maybe diversify between different time frames instead of just owning a bunch of stocks, because a rising tide lifts all boats. It's going to take it all down with it. So let's go into kind of look at a little history. And we haven't looked at these charts since very early in the year, but just to kind of show you what a correction looks like. Just kind of remind us, we're going to look at the past 3 corrections, just so we can really get a feel for, what could come. So if you look at the 2010 correction, and I want to be crystal clear, I think corrections are a good thing, because when you start to get at the end of a rally, you start to get really sloppy, chopped up, spit out. That's just kind of what happens. You get whipsawed. It's harder to trade, so you need that shakeout, that correction, so you can get a nice uptrend from there. So right here, you had the first waterfall, the reversal. I like to just really put the 20-day EMA on these correction charts, because I find that a lot of times when you get that initial sell-off, it'll come back and get rejected twice before it punches through. So you had, and this is a good chart because you see a lot of reversals This one didn't get undercut, although almost, but it eventually did. So that just goes to show you how much whipsaw activity you can have at the bottom of a correction, even getting signals of a good trading system, of a good entry points. You're going to get, potentially whipsaw 2 or 3 times before you get it right, and then it's off to the races. But, I mean, this just goes to show you right here, right after this sell-off, multiple rejections of the 20-day moving average, then it had to digest this move to the downside. And it's just like any stock. Once you have that initial sell-off, it rarely just, unless you're in a euphoric market, it rarely just comes immediately back. It needs to take some time to digest. So, if you get this and then you pick a pivot and say, okay, once it crosses above this, then I'm going to get in. Well, you would have bought right here and then you'd immediately been rolled over and stopped out. So, and that's just common. So you almost have to kind of wait for that cut just a little bit more time and then kind of pick a bigger pivot and wait for that breakout day, which is right here. And then you have a nice strong rally coming out of it. So the reason why I like corrections, because these rallies typically coming out of them are strong. So it pays to pay attention, and you want to focus on the strongest stocks. Focus on the stocks that have really sold off the least in this market correction, okay? So let's go to the 2011 correction, which this was not quite, you can see it was a downtrend. Let me kind of go back. Let me go back to April. So you can see right here, like, it is really frustrating because it's just kind of dragging you down. Like, I'd almost rather have this because I can get out of the way of this. Once you get this crack, I'm gone. But it kind of just, tries to suck you back in, and then you have the waterfall. You have a reversing candlestick right here, and it'll just chop you around just like it did in 2010. And then it undercut this candle right here, another reversal. And then you pick the spot in the W, but this is actually your buy point right here because this is where the market broke out. You have a huge, huge breakout day right here. But, then it shook you out again, and then it shook you out again. And a lot of times the market continues to digest, and these corrections happen to shake out the weak holders, right? There's a bunch of fundamental reasons why they correct, but as someone who's looking at the charts, I'm saying, okay, it's gonna wear your butt out while you are trying to trade this, and then it'll wear you out again, and then it'll wear you out again, and then it's off to the races. So after you were just chopped up and spit out, and I remember this, I think this was when the S&P 500 was, or excuse me, the U.S. market was downgraded. It sold off, and then we just had a rough summer. But if you find some long-term positions you like, and you think you're getting a fair price for them, start to nibble, and if it goes down more, you can nibble some more. So but you had multiple shakeouts, another shakeout right here. So again, just keep in mind, this is another waterfall, that it was not the bottom, and it definitely was not a V shape. So if you take away anything from these waterfalls, it's rare. I'm not going to say it can't happen, because anything can happen, but to just bounce right back and be off to the races. So if we go back to the 2015 market correction, let me take a sip of coffee. You have, man, I remember this. This was the worst because, you just could not, just whipsaw city at the top in 2015. Then you have your break, okay? So then, market breaks out, tries to whipsaw you around, takes another leg down. Then it breaks above this little W pivot, right? So then you're like, okay, it does rally, and then it shakes you out. It took a bigger, if you have a W right here, it took, you kind of have a double bottom right here, a little mini double bottom, but you have a bigger double bottom right here. I mean, it couldn't make it. And then it took another leg down, washing out all the stops that happened right here. It undercut them. Another little mini double bottom. And then, then you're off. So a lot of times when you're coming out, you really want to look for that double bottom, in my opinion, just of what I've looked at. That doesn't mean you don't trade these tradable rallies, but when the market starts to crack the 20-day EMA, that is when you are really suspect to take the next leg down. So you can trade the tradable rallies, you can try to play the reversals right here, but if it pops above the 20-day moving average and then rolls back over, it's not much of a rally, and it could likely come back and stop you out. So just keep that in mind. When you trade these tradable correction rallies or bear market rallies, you want to make sure you want to raise your stops along with it. Book some profits into some strength. So as you right here, you have a nice tradable rally, and then it just immediately rolled over, and then you have a nice tradable rally. You had a shakeout as the market did break the 20-day EMA, so you're starting to sell some stock. Now right here is interesting, and this is something I've noticed that happens coming out of corrections. Once it gets above the 20-day moving average, and it doesn't mean it can't fall below it and then the uptrend continued, but a lot of times it will hold that 20-day EMA, like it will gap down in the morning, but if it reverses in the afternoon, that is a definite, in my opinion, buy signal. When you have a breakout and then it really chops around and then it tries to break below the 20-day moving average and comes back by the end of the day, if you haven't put some money to work, from what I have studied, you definitely need to probably try to put some money to work right there, because that is telling you that the market is trying to rally, it's trying to hold that moving average, and then it's off. And I'm not saying that the 20-day moving average or moving averages are the end-all be-all. They are an incredibly simple tool to use without having to, cluster up your charts with stochastics and all these secondary indicators. They're incredibly simple, and to me, I like to look at the price and volume first. Like, that trumps everything, and I think that's very important. And I think that most people try to rely too much on secondary indicators, and it kind of takes away from having to learn, what the things a technician has to learn when you are looking at the overall stocks. So let's just kind of look at the market breadth real quick, and then we'll go in some individual charts. I want to look at a lot of charts today. You have the S&P 500. Man, let's look at the breadth down here. It is now in correction territory. No surprise there. You had the end of 2015, the correction we just looked at, it was down here. So this is the percent of stocks above the 200-day moving average, and is now at 53%. It might come down a little bit more, but this is correction territory. So it'll be interesting to kind of watch this, but this is a secondary indicator, right? So you have to look at all of the evidence in front of you to kind of just make your decisions. Price and volume first, in my opinion. Then I start to look at breadth and other things, and just right now it's kind of rough out there. So it is okay. Cash is a position. It's okay to be in cash, and I think honestly sometimes the best thing you can do right now is, one, run scans that are bucking, of stocks that are bucking the trend, and just kind of keep an eye on the ones that just can. In my opinion, the stocks that are still above their 50-day moving average, those are the ones bucking the trend. And so it's very, very simple. You can run, a relative strength screen with stocks still above their 50-day moving average. Those are the stocks, those are the strong stocks, the ones that institutions are not ready to take their profits on yet. A lot of times they can be the strongest ones coming out. But, I would be cautious, because if the market eventually does take them, which it will eventually if it gets bad enough, you still need to be willing to step aside if it's a short-term position. I don't think any position, if it's short-term, should be held, past a 10% loss. Like, it's just not worth it. You need to definitely step aside. So yesterday the Nasdaq was down 4%. Man, that's rough. Let's look at the sector summary. So you could see yesterday, on Wednesday, there was nowhere to hide. Technology was just getting beat like it stole something, which is fine because the valuations are extreme, and it has pretty much gone up the most in the last couple of years. So when you have stocks that are momentum type stocks selling at extreme valuations, eventually when the market does crack, I mean, these are the ones that are going to go the hardest. So it's not a surprise, keep in mind. But you want to be cautious how you play them unless you have a long-term position. In the last 1 week, the only thing that's up is utilities, and super staples are right up there, and the REITs are right up there, all defense, right? So money's moving in defense. The summer correction came late, which is fine. It doesn't really matter. But financials isn't really down a whole lot. Energy sector isn't down a whole lot. But then you start to get into, you know, the more discretionary type stocks like industrial, discretionary, materials, technology. You know, these are the more aggressive ones, and they're down the most. So that definitely makes sense. So just kind of keep that in mind. Let's look at the charts of these stocks. Where is that? Okay, Sector Spider. Let's just kind of look at the charts of these. Chart book. Okay. Oh, let's do the 10 per page. Just to kind of see. So you have consumer discretionary stocks. You know, this is going to move with the market. It is pulled back, looks a lot like the S&P 500, looks a lot like the Nasdaq. It's right on the 200-day moving average, so it hasn't stopped yet, or hasn't broke yet, but, you know, it is without a doubt feeling the sell-off. Same thing with technology. You have technology that was down almost 5% yesterday. You know, it tried to hold up. It broke out to an all-time high when the Nasdaq did not, but it eventually just broke. It broke this uptrend right here, and now we're kind of keeping an eye on it for these 200-day moving average lines. Industrial also got slaughtered, and it's kind of been a choppy year for industrials. It hasn't been as smooth, but then you have a nice uptrend, and then, you know, it tries to break out and it just fails. So again, you have the more aggressive sectors, and then you have materials, which is tied to a lot of commodities. You know, you have the death cross. The 50-day moving average is under the 200-day moving average, and it's one of the weakest one, if not the weakest. So I'd definitely be cautious if you're thinking about playing some miners, because they're looking, or some materials, they're looking very, very weak. Energy is probably looking the strongest, or is the closest, probably energy and healthcare, to the all-time high. It did get hit yesterday 3%, but it's only 3.5% above an all-time high. It's hard to get too bearish on energy when it's 2 days away from hitting an all-time high. Staples, you know, you had a nice rally in late summer and has just been consolidating. So if you ignore the fact that it's still below its January sell-off, January high, you know, this is a pretty good trend, and then a tame consolidation. So we'll just kind of have to wait and see if this shows a little bit of relative strength relative to the overall market. It doesn't mean it's going up, but it could show relative strength just because these are the more conservative stocks. Healthcare is still looking pretty good in my opinion. I would almost look for just an oversold bounce out of this one. I mean, that's a really, really strong rally. You have, and I saw a chart and I meant to put it up. I didn't get it prepared, but you know, healthcare is just now breaking out of a very long-term chart relative to the S&P 500. So you have these sectors that can underperform for years and then outperform for years, and I think healthcare really could be in the early stages. You know, after a lot of biotechs really topped in 2015, and just some of the larger caps went nowhere for several years. So I still think this is the honey hole of fishing. Utilities is showing strength. That's no surprise. It's going up as the market's selling off. You know, sometimes I get asked, should I buy utilities? And I'm just like, if the market's so bad you have to buy utilities, why not just be in cash? Because just because the market's bad, that doesn't necessarily mean utilities is going up. To me, the risk reward for just having to park my money somewhere just because the market is bad is just, it's not there. Financials hasn't came close to the January high. It's pretty weak, which is kind of interesting because you have the interest rates that have broken out above 3% and were rising as of recently in the last month. Typically, the XLF is going to follow, and it just hasn't happened. So let's just kind of keep our eye on that. Even though they're positively correlated, they have not necessarily been moving in tandem, and there's a lot of periods where these relationships can decouple from each other. I'm more interested to see if when the pullback is over, if leadership emerges from the financials. We got a lot of banks that are about to start reporting, so I think we'll see it could go either way. Let's look at some industry ETFs. I'm going to drag this over here, and we're going to look at just a few of the strongest and a few of the weakest. So a few of the strongest are, and I'm just by relative strength, healthcare providers, IHF. This is a huge, I mean, this is way above the January high. And if you think financials are still way below it. But healthcare providers still very strong, still above the 50-day moving average. I think that's something that you want to dive a little bit deeper on to find out, you know, where some strength is. Some individual stocks. Medical devices, even though they're strong on a relative strength, they have started to sell off a little bit. So this just kind of goes to show you that healthcare providers are the industry within the healthcare sector that are showing more relative strength and holding up better than the medical device sector. So you have the XOP, the Spider Oil and Gas Explorer and Production ETF. It's really been in a trading range, right? And sometimes I do hate trading these commodities because they're so volatile, and it's hard to really catch a trend that is not going to just chop you up and spit you out. So on the weekly chart, we have a consolidation above the 40-week moving average, the black line. So it is showing relative strength. The aerospace is, you know, sold off like everything. So just very few things really. If you look at all these, and we can continue to go down, I mean, tech is down, utilities is up, but it's not really at an all-time high. So if you look at them, you know, continue to focus on the strong. What is holding up? Now, if we look at that on the inverse, let's look at what is the weakest. And copper miners is, and this is just only 25 industry ETFs. It doesn't, you know, this isn't all of them, but these are some that I just track on a daily basis to find out what's the strongest, what's the weakest. Copper miners, that really doesn't look like anything good. It's in the death cross. It's in a downtrend. I'm staying away from it. Gold miners, same thing. I mean, they just absolutely had a false breakout right here. And then it's one reason why we use stops. And I think I was participating in this breakout, and then it just rolled over, and I got stopped out for a small gain, and then something bad happened. So I mean, thank goodness for stops, because I would be way down. Home construction stocks. I mean, this is probably the industry, the non-commodity industry, that is just in the worst shape. It's absolutely never recovered. I'm sure it has to do with interest rates and a bunch of other stuff and fundamental reasons why, but I mean, this peaked at 44 and is now at 32. That's a really nice bear market for home construction stocks. And if you look at it, they really haven't even recovered from the 2006 peak. I mean, it tried to get all the way back up here. This is a monthly chart, and I mean, I was just rolling over again. So tough time for construction stocks. This XBI Biotech, this is an equal weight biotech, and there for a while, biotech's showing a little bit of strength right in here. I thought they were going to just make a big move, and then they just cracked wide open. So there's clearly a risk off in biotechs. So I would just kind of be cautious And I think a lot of it's kind of the more smaller biotechs. I think some of the larger caps have been holding up just fine. So we'll wait and see. Let's just look at some individual stocks. I'm just kind of going to go to my watch list. So I want to look at just some of the leaders that I think are the leaders as far as growth stocks go, and now they're just starting to crack Roku. You talk about the kind of companies that change the way we live. I think Roku is one of them. With the cutting the cord, so to speak, type of time that we're living in, and I think the future is bright for Roku. But it's not a profitable company, and it's probably selling at a high valuation, which you don't know because the earnings per share isn't positive. But major mutual fund increase ownership. Solid sales increase, solid earnings increase, even though it's not anticipated to probably make a profit till 2020. Really strong trend, and now it's just cracking. So I thought this could have held until yesterday. It was down 12%. This is a leader, and it's down 12%, and that's just growth stocks. I mean, they're going to get hit pretty hard. Trivago was a stock I've been talking about a lot. I had to sell it yesterday for a small gain instead of a big gain, and that's just part of it. If you're going to be willing to hold something for a long term, I mean, it's trend following. You could be way up, and then you could give a lot of it back. I don't regret it because sometimes if you find a stock and you buy it right, you have to go for it. But I told myself I knew this 200-day moving average would probably reject. And it did, and I was hoping the 20-day would hold. If not, I was hoping the 50-day would hold, and it didn't. So, for whatever reason, it's time to go. And I'm fine with that. It's part of trading. The most important thing, and I can listen to Market Wizards all day. All 3 books on audio anytime I'm mowing the lawn or just doing some cleaning or doing something. I'm going through one of those things a lot of the times, and this is just kind of one of those times. And the one thing that I'll talk about is protect your capital. In case have a plan in place when you buy something, have an exit on the upside and on the downside, and just make sure you protect your capital in case something bad happens. And that's what we're doing right here. So there will be new setups, there will be new trades. It's part of it. So let me continue to go through here. Another leader is CARG. This is a profitable company. Now it's selling at an incredible valuation, and I mean, in my opinion, sometimes I think that they deserve it because they come out IPO at an incredible valuation. People pay it. You're in a growth market. It goes up. And then, when the valuation can't be justified and the market starts to sell off, it's going to get hammered. Now, it's got great sales, great earnings, everything are there, good return on equity, good mutual fund sponsorship increase, almost doubled in 4 quarters. But this was a leader. Just huge gap up right here. And then failed breakout, failed support. Maybe if there was a 100-day moving average line, maybe it'll find support. But, I mean, this is not something I want to get involved in. So I'll wait, but it did undercut this base, so that does reset the deck. But again, and then we look at Stitch Fix, which I thought, which was a strong stock, went from 18 to 52 very quickly, so more than doubled. Bad earnings report. And that's the downside with growth stocks. If you're playing a triple-digit earnings type of growth stocks, one bad earnings report, one bad earnings outlook, you're going to have a bad day. And it did, and it has not came back. So if you're going to sell at high valuations, once the music doesn't even have to stop, once it slows, you're going to get slaughtered. So that's what happened. Curo Group. I mean, this is just another stock that I owned, and I sold it on this day, right here, right at the close. I had some shares. It found support of the 50-day moving average. It sold. It broke. I was out. And I'm glad that I was, because now it's down an additional, or is that 28? So maybe not quite 20%, maybe like 15%. But I mean, I own some shares, so that saved me. Just having a plan in place and not freezing saved me some money. So Camping World was an article I sent out the other day. It just kind of looks interesting. This is a position I own, and it has not been a good year. But it could really go, you know, one way or the other. But during the sell-off since Friday, it's been going up. Now, it was down yesterday with everything, but it was down yesterday in low volume. It just feels like there's somebody swiping off shares anytime it cuts below 20. So this could come down to the bottom of the base, and this could break the base. But, you know, if this stays here and consolidates and then it breaks out, I would take that seriously. So when you're talking about some stocks that have already been way up, now they're starting to sell off. You have a stock that's already sold off and is now showing just a little bit of relative strength the last couple of weeks. Not a lot of distribution during the sell-off at all. As a matter of fact, there is none. And then it's just, this is that first stage triangle base, just a big first stage triangle base. So, just kind of worth noting. Where was that? Just saw GoPro. So GoPro was another potential first stage consolidation that we were looking at a few weeks ago. You know, it broke out. It's just kind of stocks stair-stepped their way higher. It gapped up, and I don't really buy gap ups. And when the market started to sell off, and then it broke yesterday, the 200-day moving average, opening the door to falling back in this consolidation right here in this box. So I would just be cautious, because the difference between, you know, again, a simple rule could have been the 200-day moving average. So if you'd have bought somewhere in here, then it broke. It doesn't look like a long way, but it is a long way from 586 to 442 to the bottom of this consolidation, which is where it could head. So again, you don't know if that's going to happen or not, but you know, you could always take some off the table. And I didn't buy this just because the stock is looking interesting, but the setup isn't quite there for me yet. So I just passed, hoping it would come back to the 200-day moving average, but it did. But because I don't always like to buy pullbacks, I waited, and then support broke. So it worked out in my favor this time. Sometimes it doesn't. Sometimes stocks find support, and I should have bought it. But either way, you know, I hope this was helpful. I hope you just at least, you know, have a game plan for all your positions, all your short-term positions, all your long-term positions. Your game plan probably, if you have conviction, is to buy more. You know, we see this as a long-term opportunity, even though we might not be at the bottom yet. So I hope this was helpful. I wish everybody a good day.